Okay, so good morning, everybody. My name is Miguel Calabrese, and I am from Blue Rocket Accounting. Okay, just a minute some more. And today's session is a blast off with an introduction to accounts for business. So let's get started with today's session. So welcome, Blue Rocket Accounting. We're a team of friendly, knowledgeable accountants who work with local business owners to help them on their journey and rocket them to success. We also have a wealth of partners that we work with. So if there is anybody that you're interested in getting in touch with or knowing, then feel free to drop us a line and we can make an introduction if we can. So today's session, so the agenda, we are going to cover just a brief introduction. Accountancy is easy. What are accounts? Your profit and loss account and your balance sheet. So over to introduction. So information is the key to understanding the successes and failure of your business. Having good accounts, good bookkeeping is a necessity in any business because you need to understand how you're performing to give you the information to make the decisions to push your business even further. So what your business needs. So these are a couple, well, there's a few of these. This is like a complete list, but so we'll have a business plan, financial forecasts, your software. So this is your bookkeeping. So software should be updated on a daily or a weekly basis at maximum. Some people do push it to a month. You've got to find what works for you. It just depends how busy you are. Your accounts produced on an annual basis. So that's what this session is focused on. But there'll be monthly reconciliations, monitor of actual trading results against your forecasts, cash flow forecasts, and then cost and profitability of each of your contracts / jobs clients. That's a whole list of what business owners should be producing or have produced for them. But today's session is on point 3, so the accounts produced on an annual basis. It's worth noting that this is a basic guide designed to help you take the first steps in your business. It explains what accounts are, why you need them, and what they mean. It also explains the minimum accounting records that your business will need to keep. This guide has been written for the managers and owners of small businesses. For simplicity, the examples are given based on the accounts of a small limited company. However, the principles apply equally as if you are a sole trader, so someone who's not a limited company or a partnership, or even if you're a multi-million pound businesses, the principles apply the same throughout any business for this. So accountancy can be easy when you know how. So understanding accountancy and finance can be described as driving a car. It fills most people with dread and fear, but once they've had a bit of experience, it becomes second nature and they wonder what all the fuss was about. They probably even start to do it without thinking, just as you drive your car instinctively, knowing where you're going, changing gears automatically. So don't feel alone if you're panicked by understanding your accounts at the moment, because that is pretty normal. But once you get used to it, it'll be perfectly fine. What other things are important is who is interested in your account. So you'll have your bank manager if you are looking for finance, your mortgage provider. If you run a business and you want to buy a home or remortgage, they will look at your accounts, whether you're a sole trader, partnership, or a limited company. The tax man, of course, they'll look. Your customers may want to look at your accounts to see if they want to do business with you, and suppliers from a good credit risk rating, if they're going to give you some credit for their suppliers. But most of all, you should be interested in your accounts. And that's the key, is that you need to be interested in your own accounts to see how well you're doing so you can make decisions quickly so you can get the impacts moving forward. So a definition of an accountancy. So accountancy is about identifying and recording, analysing and explaining the financial implications of business transactions and decisions to enable business people to understand the performance of their businesses and to help them make decisions and take actions which assist in achieving the objectives of that business. So on the screen, I tried summarizing it. So identifying, recording, analyzing, and explaining. That's the key definition of accountancy. And we'll touch on that as we go through this session. So there's two types of accounts. So there's several types of accounts. However, they can be grouped onto two main headings. We have financial accounts, and for limited companies, these are sometimes also known as statutory accounts. For sole traders, these are your accounts that form the basis of your tax returns. And then we have management accounts. So just to expand on those 2 points a bit, financial accounts, these are compulsory for companies and must be sent every year to shareholders in your company and to Companies House and to HMRC. So most SME, small businesses, the directors are the shareholders, so it would be you who's looking at it. They must also follow a standard set of rules and conventions and show what went on during that financial year. They are mainly used by people outside your business. And that's the funny thing, is the financial accounts, the statutory accounts, are mainly used by people outside your business. So your bankers, customers, suppliers, and HMRC. The reason being is because part of that information is made public knowledge, and that's how people get credit rating on your businesses. That's how HMRC know what tax liability to expect. And because they're done in such a standard set of rules, when you look at a full set of accounts, statutory accounts, financial accounts, 90% of the pages are meaningless to SMEs. Sole traders and partnerships must also produce financial accounts, although they do not need to be sent to Companies House, and there are not so many rules governing them how they must be set out and what they must contain. So that's a key difference. If you're a limited company or an LLP, there are strict rules around how your financial accounts can be produced, followed, and submitted, whereas if you're a sole trader or a general partnership, not so much. The other type of accounts is the second bullet point, which is management accounts. This type of accounts are essential for well-run businesses, but are not strictly required by law. As their name suggests, management accounts are mainly used by management to know where the business is and to take action. In fact, it's very rare for them to be shown to anybody outside the business, although it is becoming common for banks to ask for them to make lending decisions. There are no rules that say what the management accounts must look like. It is up to each business to decide what format will best help it to understand what is going on, control the business, and make better decisions. And that's one of the key differences. Management accounts are designed by you, for you, so you get the information that you want. They don't have to fit into certain holes and boxes that the financial accounts are. Management accounts often predict the future as well as keep track of the past, i.e. they usually include forecasts of what's going to happen tomorrow, as well as recording what happened yesterday. Whereas in contrast, financial accounts only ever record what has already happened in the past. Regardless of what type of accounts there are, both sets, management and financial, use the same basic information, which they get from the same place, the company's books. So that's your bookkeeping software. It could be Xero, Sage, Cashflow, QuickBooks, from there. So the information comes from the same place, but what's happened is one is to meet legal requirements and the other is for your information. So what are accounts? So we said before that business, finance and accounts are a bit like driving a car. Good drivers use the dashboard to monitor their progress. And in just the same way, good business managers use their accounts to monitor their business progress. So accounts are, in sense, your business dashboard. The two key instruments on your car's dashboard are probably the speedometer and the mileometer. These are the equivalent to the two key elements in any set of accounts, the profit and loss and the balance sheet. So they have changed names recently. Profit and loss now is statement of income and expenditure, and the balance sheet is statement of financial position. And that's because of accounting law that it's changed. But I'll keep using the profit and loss and balance sheet because they are the most common names used for businesses. So there's some basic principles that you need to be made aware of. So most accounting is a little more than applied common sense. However, there are two golden accounting rules that are not immediately obvious. And so it's worth spending a couple of minutes describing them now. So we have what's known as the accruals principle. Your account should reflect things when they arise or are earned, which is not necessarily the same time as when you actually pay or are paid for them. For example, us as your accountants would include an April sales invoice in your April accounts, even if your customer doesn't pay you until August. So that's a big factor. So the accruals principle essentially means that everything in that period we are looking at, that 12-month period or that financial year end, needs to be included, whether it's been paid, not paid, and sometimes even if it's not been invoiced. So there is a common term used as work in progress, and that's where you carry out work but not yet invoiced it. We would need to include that. So you want all the work that's been carried out or earned in that period to be shown in that period, even if the invoices are dated afterwards. Then we have revenue versus capital payments. Some of the things you spend money on will not be regarded by us as your accountant or the tax man as reducing your profits. For example, the money you pay to buy a new car or pay off a loan. So accounting standards say that payments like these shouldn't appear in the profit and loss. Instead, their effect is confined to the balance sheet. The key distinction here is between capital expenditure and revenue payments. So revenue payments are the running costs of the business, the type of expenses that buys goods and services that are used up quickly, e.g., so for example, wages, advertising, rent, stationery, etc. This type of expenditure is shown in the profit and loss and is often referred to as having been expensed. Capital payments, on the other hand, relate to things that continue to benefit the company for several years, e.g. computers, cars. They also include paying off loans. This type of expenditure is shown in the balance sheet and is often referred to as having been capitalized. So that's the main difference. Is if you've got something that's used up relatively quickly, it's going to fall into your profit and loss and reduce your profits. If you've got something that lasts longer, the life of that asset or the term of the payment, then it will appear on your balance sheet or a part of it will appear on your balance sheet. So now we've got some basic principles down and the two golden rules. We're going to look at your profit and loss. So if we go back to the car analogy, so in the car, the speedometer shows how fast you're going and how quickly you're going to get where you want to go. This is the equivalent to the profit and loss, which shows how fast your business is accumulating profits. So how fast your business is making profits in that period. Both the speedometer and the profit and loss account only make sense when viewed over a period of time. And that's the key, viewed over a period of time. So the speedometer shows miles per hour. The profit and loss shows profits per year. So when we're looking at the profit and loss, commonly it's showing profits per year. You do have long periods and short periods, and the management accounts are slightly different, but from a financial accountant point of view, 9 times out of 10 is profits per year. And if we delve into the profit and loss a little bit more, so sales is all the income earned, generated by your business, even if it's not yet paid. So if people owe you money, their sales will still be included in your income, which means you are paying tax on that money before you get paid, which is why it's important to keep your debtors, so people that owe you money, under control. And then we take off costs. So this is your revenue expenditure. So this is cost of goods, services, supplier support, those sales, even if you've got stuff on credit, you still include it in your costs. And then sales, takeaway costs equals profit. So that's how much your business has really made. So just to look at an example with numbers. So this is a business, typical business, just picked up. The numbers are all round. It's not a real business. So we have turnover at the top. So let me get my highlighter out. So we have turnover at the top. So this is sales invoices raised, even if they haven't been paid. And then what we have here is cost of sales. So here, all the costs that are related in generating, delivering, and producing those sales go in cost of sales. So if you're buying a product in and reselling it, that would be a cost of sales. If you've got sales staff or production staff, that would be cost of sales. And that's how we determine a gross profit. So we take the turnover less your direct costs or cost of sales, and that gives us a gross profit. From an accounting point of view, that's important when it comes to looking at management information and looking at gross profit margins, which we won't touch on today, but it's worth noting. And then we have overheads of a business, and this is all of the fixed costs of the business, or all costs of the business that would still be there even if this turnover figure went up or down. So these are like your director's remuneration, so your director's salary, your rent and rates. So that's not determined on your turnover. It will be 25,000 a year. Telephone, generally you get fixed contracts these years. And then interest paid on the loan would be fixed. Then we have accounting terms like depreciation, but we'll touch on. So that's the main difference between the two. So you have everything. Cost of sales is everything relating to delivering those sales. And then you have overheads where there's cost involved that have no relation to sales. So if that doubled, some of these wouldn't double. But if that doubled, you'd expect to see an increase in these as well. Then we have other operating income, which is bank receipts, bank interest. So we show that separate. And then rent received if we're renting it out. So we show these types of income separate. But then we have what we call retained earnings at the bottom. So this is net profit before tax. Then we have our taxation and retained profit. Retained profit, if we're using the car analogy, is the fuel left in the tank for the year. This is how fast you were going in the year. This is the fuel left over because of the tax. The second part of the reading your accounts is the balance sheet. So the balance sheet, on the other hand, is like the mileometer. A mileometer records how far the car has traveled and is often used as an important factor in deciding how much a car is worth. In the same way, your balance sheet measures how far your business has traveled. It is a snapshot of where the business has got to and gives some indication of how much it might be worth. But like the mileometer, it tells us little or nothing about how or how quickly it has got to where it is. So if we take another look at the balance sheet, your balance sheet comes in two halves. You have the top half, which shows the company's net assets. So we have the assets, so that is everything your business owns. And there's two types of assets. We'll see you have fixed assets and current assets. We'll see that in the following pages. And then we have everything, well, less the liabilities, which is everything your business owes out. So what it owns less what it owes out gives you a net assets, which is a rough measure of how much your company is worth, but only when you come to sell a business, this is not the way to sell it, balance sheet value, because of it doesn't take into account the things like goodwill, which are not generally shown on the balance sheet. However, it gives you a quick indication if you've got more assets than liabilities. So what we never want to do is for the balance sheet to be in a negative position, which means it's insolvent. The second part of the balance sheet is how those net assets have been generated. So it looks at share capital. So this is how much money you invested into the business at the beginning. This can be £1, £100, £1,000, whatever the share capital was, what you set up in the business. But it also, if you take on investors or anything like that, that would be shown there. Plus the profits of how much has been earned and not spent since the business has started. So that's your retained earnings. So you remember the fuel in the tank? That's what that figure goes into. And then that equals your net assets again. And that net assets should equal exactly the same as the net assets on the previous page as we saw here. So the net assets, they're both called the same thing. And balance sheet, hence they need to balance. So if we look at a typical balance sheet, so we have fixed assets. So remember I said there's two types of assets. So we have fixed assets at the top. So this is everything what we have capitalized. So when we're talking about the revenue expenditure and capital expenditure and the profit and loss, so anything that's capitalized would go here. So property, fixtures and fittings, so things like computers, desks, chairs, if you've had an office fit out, cars, any expensive tools. There are rules around what you would capitalize and what you wouldn't. So as a general rule of thumb for small businesses, if you spent over £150 on something that's going to last more than a year, you would look at capitalizing it. If you spend 5,000 and it doesn't last 3 months, then you don't capitalize it because you've used it up. That's the point of a capital asset, is that we're trying to see the life of it, the value of its life over a period. Then we have current assets, and the reason they're called current assets is ideally these numbers here are stuff that we can get our hands on relatively quickly. So stock, we should be able to. Trade debtors is people that owes you money. Directors loan account is zero, so we need that, and then cash at bank or in hand. So when we come to prepare accounts, all of your cash gets lumbered together. Even if you had 25 accounts, it will just be one figure. We have the current liabilities. So this is the reverse of current assets. So this is stuff that's due within 12 months. So bank overdraft, loans, trade creditors is the reverse of trade debtors. So it's money that you owe to people. Taxation and security is PAYE, VAT, or corporation tax. And director's loan account, which is quite common on SME businesses, is money that you've put into the business. So this particular director has lent the business £10,000. And it's lent, which means it can take it back once the money's available. And then we have anything over 12 months as long-term loans, which gives us a net asset value of 6,538. So when we talked about balance sheet being the business worth, so technically, if this business was to stop trading at this date, sell its property for 50,000, sell all of its fixtures and fittings for 40,000, sell all of this and collect it all in and get its 80, and then pay all of this off, it would walk away with 6,538. And that's why it says it's the balance worth of your business, because it's the closing down value, not the selling value. So don't get those mixed up. And then we have your shareholders fund. So we have the share capital at the bottom, the retained profits. That's the business, the profit generated for this year, and then the profit and loss reserve. So that's the fuel tank that's been built up over the number of years. That's going to continue adding to the business. So the more profit you leave into the business, in theory, the more value there is, more fuel in the tank for you to grow the business. But also the closing down value should increase from that point of view. it's worth noting when you see numbers on accounts that have brackets like this or like this, it means they are a minus. So if they're a minus, it's a negative, which is something that doesn't always come up. And it's a number of conversations that I've had with startup businesses that didn't realize that. So it's worth noting that. So what we don't want is this net asset ever to be in the minus. If it is, and there's a story behind it, then it's worth noting. But if this number becomes a minus, then you become technically insolvent. So that is a quick flag for you when you're looking at your balance sheet. Is it a positive number or is it a minus? And that's the key starting point. So positive number is good, negative number is bad. Even if it was £100, it's still good. But the smaller that net asset number, the less likely you are to get any type of lending. So a top tip, your accounts can only be as accurate as the books you keep. So books you keep is bookkeeping. So if you use Xero, Sage, Cashflow, QuickBooks, whatever it is, your accounts use those to create, the accountant use those books to create your financial accounts. And if you employ them to do your management accounts, then they use those as well. And it's much the old saying, if it's rubbish in, then it's rubbish out. There are checks that we carry out, but for you, bookkeeping, if you have your bookkeeping on point, then that allows everything to run much more smoother and more accurate for you going forward. We also have a dedicated website, which is kentbusinesssupport.co.uk, where we have a full video library and access resources for startup businesses. And please feel free to go on there. There is a price for £29.99 to access it all. However, if you do message me or the team after the meeting, we'll send you a discount code and you can get it for absolutely free, providing you sign up. There's some great videos on there. This part of this introduction to accounts is only one aspect of this website, which is why we're trying to approach it a different way. But there's a lot more information in there, like what insurances you should have, HR policies if you're employees, even how you pay yourself if you're a limited company. But my favorite, of course, is the bloopers. So if you do get access to it, if you do message us, then please have a look at the bloopers. And I believe we have come to the end of the session. Does anybody have any questions? If you do, please feel free to ask in the chat.